Trading Order Types Cheat Sheet. One essential aspect of successful trading is understanding the different types of orders available, each designed to serve specific purposes and cater to various trading styles. These order types provide you with the flexibility and control needed to execute your trading strategies effectively. These orders act as instructions to your broker on how to execute your trades, giving you control over entry and exit points, risk management, and overall trade management. Forex Orders Cheat Sheet. In this lesson, let's review the most common order types you learned from the previous lesson. We'll delve into the details of each order type, exploring their unique characteristics, purpose, advantages, disadvantages, and ideal use cases in the Forex market. Market Order. A market order is a type of trading order that is executed immediately at the best available market price. This type of order prioritizes immediate execution over getting a specific price. It ensures that the trade is executed quickly, which can be crucial in fast-moving markets. Purpose. The main purpose of a market order is to ensure quick and certain execution of a trade. It is most suitable when the priority is to enter or exit a position promptly, without being concerned about getting the best possible price. Example. Suppose you want to buy 1,000 euros, EUR, with US dollars, USD. The current market price for EUR USD is 1.1050/1.1052, bid-ask. If you place a market order to buy EUR, your order will be executed immediately at the ask price of 1.1052. This means you will receive 1,000 euros and your account will be debited the equivalent amount in US dollars at the prevailing exchange rate. Advantages: guaranteed execution, in most cases. As long as there are buyers or sellers in the market, your order will likely be filled. This is important when you need to enter or exit a position quickly. Simplicity. Market orders are straightforward and easy to understand, making them ideal for beginner traders. Speed. Market orders are executed almost instantly, allowing you to act quickly on market opportunities. Disadvantages. No price control. You have no control over the exact price at which your order is filled. You might end up paying more to buy or receiving less to sell than you anticipated. Slippage risk. In fast-moving markets, the price can change quickly, and your order might be filled at a less favorable price than the one you saw when you placed the order. Not suitable for all markets. In illiquid markets where there aren't many buyers or sellers, a market order might not be filled or might be filled at a significantly different price from the one you expected. Limit order. A limit order is an order to buy or sell at a specific price or better. Unlike a market order, a limit order might not be executed immediately if the specified price isn't reached. Purpose. The main purpose of a limit order is to give you more control over the exchange rate. The main purpose of a limit order is to give you more control over the exchange rate at which you enter or exit a trade. It allows you to set a maximum price you're willing to pay when buying, bid price, or a minimum price you're willing to accept when selling, ask price. Example. Suppose you want to buy 1,000 euros, EUR, but only when the exchange rate reaches 1.1000 or lower. You place a limit order to buy EUR/USD at 1.1000. Your order will not be executed unless the market price reaches your specified limit price or lower. Advantages: price control. You have full control over the exchange rate at which your order is filled, ensuring you get the price you want, or better. Reduce slippage risk. Since you specify the price, you avoid the risk of unexpected price changes leading to unfavorable execution prices. Suitable for all market conditions. Limit orders can be used in both liquid and illiquid markets, as well as during periods of high volatility. Disadvantages: no guarantee of execution. If the market price never reaches your specified limit price, your order will not be filled. Potential for missed opportunities. If the market moves quickly in your favor, your limit order might not be triggered and you could miss out on potential profits. Requires patience. You might need to wait for the market to reach your desired price level, which might take time. Stop order. A stop order, also known as a stop-loss order, is an order to buy or sell once the price reaches a specified level, known as the stop price. Once the stop price is triggered, the stop order becomes a market order and is executed at the next available market price. This type of order can help protect you from large losses by automatically exiting a position if the market moves against you. Purpose. The purpose of a stop order is to limit potential losses on an existing trade. It acts as a safety net, automatically closing your position if the market moves against you beyond a certain point. Example, suppose you have a long position bought in EUR/USD at 1.1050. To protect your trade from potential losses, you set a stop-loss order at 1.0950. If the market price falls to 1.0950 or below, your stop order will be triggered, and your position will be closed at the next available market price, limiting your losses. Advantages: risk management. Stop-loss orders are essential for risk management, as they help you control and limit potential losses on a trade. Peace of mind. Setting stop-loss orders allows you to step away from the screen without constantly worrying about monitoring your positions. Automates. Exits. Stop orders automate the exit process, ensuring you get out of a losing trade, even if you're not actively monitoring the market. Disadvantages. No guarantee of exact price. When the stop price is triggered, your order becomes a market order, and you might not get the exact stop price due to market volatility. False triggers. In volatile markets, short-term price fluctuations can trigger a stop order prematurely, even if the price later recovers. Requires careful placement. Setting stop-loss orders too close to the current price might lead to premature exits, while setting them too far away might not provide enough protection. Stop limit order. A stop limit order combines the features of a stop order and a limit order. It's an instruction to buy or sell a currency pair once the market price reaches a specified stop price. However, unlike a stop order that becomes a market order upon trigger, a stop limit order becomes a limit order with a specified limit price. Purpose. The purpose of a stop limit order is to provide more control over the execution price compared to a regular stop order. While a stop order guarantees execution but not the price, a stop limit order guarantees the price but not the execution. It is used to limit losses or lock in profits at a predetermined price level, but only if the market reaches that price. Example. Suppose you have a long position, bought, in EUR/USD at 1.1050. To protect your trade, you set a stop limit order with a stop price at 1.0950 and a limit price at 1.0900. If the market price falls to 1.0950, the stop price is triggered. However, your order will not be executed unless the market price reaches 1.0900 or better. Advantages. Price control. You can set a limit price to ensure your order is executed only at your desired price or better, avoiding slippage. Risk management. Similar to stop orders, stop limit orders help you manage risk by automatically closing a position if the market moves against you. Flexibility. You can customize both the stop price and the limit price to fit your specific trading strategy and risk tolerance. Disadvantages. No guarantee of execution. If the market price gaps through your stop price and never reaches your limit price, your order might not be filled. Partial fills. In fast-moving markets, your order might be partially filled at different prices if the limit price is reached, but the entire order cannot be filled at that price. Requires monitoring. You need to monitor the market after the stop price is triggered to ensure your order is executed at the desired limit price or better. Trailing stop order. A trailing stop order in Forex trading is a type of stop-loss order that automatically adjusts to follow the market price as it moves in your favor, but it doesn't move back against you. This type of stop order adjusts automatically as the price increases, ensuring you lock in gains. It's designed to lock in profits as a trade becomes profitable while limiting potential losses if the price reverses. Purpose. The primary purpose of a trailing stop order is to help traders capture more profits by letting winning trades run while still protecting against potential losses. It's a dynamic form of a stop-loss order that adjusts automatically based on market movements, taking the emotion out of managing stop-loss levels. Example. Suppose you have a long position, bought in EUR/USD at 1.1050, and set a trailing stop order with a 50 pip trailing amount. If the market price rises to 1.1100, your stop-loss order will automatically adjust to 1.1050, 50 pips below the current price. If the price continues to rise, the stop-loss will continue to trail behind, locking in more profits. However, if the price falls from 1.1100 to 1.1050, the trailing stop order will trigger and close your position, limiting your losses to 50 pips. Advantages: profit maximization. Trailing stops help you capture more profits by letting winning trades run as long as the price keeps moving in your favor. Automatic adjustment. The stop-loss level adjusts automatically, eliminating the need for manual adjustments as the market moves. Reduced emotional trading. Trailing stops take the emotion out of managing stop-loss orders, preventing you from exiting a trade prematurely or letting losses run. Disadvantages. No guarantee of exact price. When the trailing stop is triggered, the order becomes a market order, and the execution price might not be the exact stop price due to market volatility. False triggers. In volatile markets, short-term price fluctuations can trigger a trailing stop order, even if the price later recovers. Requires careful setting. Choosing the right trailing amount is crucial. Setting it too close to the current price might lead to premature exits, while setting it too far away might not provide enough protection. Good till cancelled, GTC, order. A good till cancelled, GTC order is an order that remains active in the market until you cancel it manually or it is filled. GTC orders can be used with various types of orders, such as limit and stop orders. Purpose. The primary purpose of a GTC order is to provide flexibility and convenience to traders who want to set up orders in advance, and let them remain active until specific price levels are reached. They are particularly useful for long-term traders or those who cannot actively monitor the market. Example. Suppose you believe that EUR/USD will eventually rise to 1.1200, but the current price is 1.1050. You place a GTC buy limit order at 1.1200. Your order will remain active until the market price reaches 1.1200, or you decide to cancel it manually. Advantages. Flexibility. GTC orders allow you to set orders in advance and not worry about them expiring at the end of the day. Convenience. You don't have to constantly monitor the market and re-enter your orders every day. Long-term trading. GTC orders are suitable for long-term traders who anticipate specific price movements over a longer period. Price control. Similar to limit orders, you have control over the price at which you enter or exit a trade. Disadvantages. No guarantee of execution. If the market never reaches your specified price, your order will remain open indefinitely until you cancel it. Potential for missed opportunities. If the market moves quickly in your favor but reverses before reaching your GTC order price, you might miss out on potential profits. Requires monitoring. While you don't have to monitor the market daily, it's still essential to periodically review your open GTC orders to ensure they align with your current trading strategy. One cancels other OCO order, and one cancels other OCO order consists of two orders linked together, typically a limit order and a stop order. If one order is executed, the other order is automatically canceled. Purpose. The primary purpose of an OCO order is to automate trade exits and manage risk effectively. It ensures that once your target profit or maximum acceptable loss is reached, your position is automatically closed, preventing further gains or losses. Example. Suppose you have a long position bought in EUR/USD at 1.1050. You want to take profit if the price rises to 1.1150 and limit your loss if it falls to 1.0950. You can place an OCO order with a limit order to sell at 1.1150 and a stop-loss order to sell at 1.0950. If either the price reaches 1.1150, triggering the limit order, or falls to 1.0950, triggering the stop-loss order, the other order will be automatically canceled. Advantages: automated risk management. OCO orders automate the process of exiting a trade, removing the need for constant monitoring. Profit-taking and loss limitation. You can set both a take profit and a stop-loss level, allowing you to capitalize on gains while protecting against losses. Reduced emotional trading. By predefining your exit strategy, you reduce the risk of making impulsive decisions based on emotions. Flexible. You can customize the take profit and stop-loss levels to suit your risk tolerance and trading strategy. Disadvantages. Not all brokers offer OCO orders. Some brokers might not offer this feature. Requires understanding. It's important to understand how OCO orders work and how to set them up correctly to avoid unintended consequences. Summary. Understanding the various order types available for trading is essential for executing your trading strategy effectively. Market orders, the most basic type, prioritize immediate execution at the prevailing market price. Limit orders, on the other hand, allow you to set specific price levels at which you are willing to buy or sell. Stop orders act as safety nets, automatically closing your positions to limit losses if the market moves against you. And trailing stop orders, a dynamic variation of stop orders, trail the market as it moves in your favor, locking in profits while still providing downside protection. Each order type offers its own set of advantages and disadvantages. By familiarizing yourself with these order types, you can gain better control over your trades and improve your overall trading performance.